All
Yeah,
right, you ready?
so I'm ready. But yeah, so here I'll throw this out at you. You know, Brandon and I are the econo geeks primarily. And so here's the concept. Yesterday we had PMI, and I'll get into the details nitty-gritty in a second. We had purchasing managers index. Now this is also kind of a survey. They're going to talk to the people that are the buyers of the materials that go into the
Mm.
factories, or the hirers for services, or. So these are one of the earliest things you can get in the economy on the purchasing managers index to see kind of how the health and strength of the economy is. But here's the thing, when you looked at the factory orders and the setups and the PMI, and it suddenly went back into positive, if it was truly about growth, we would be saying, oh, then the economy is turning and going back up. But looking at the details a little bit deeper, what we had your input costs. Okay. Input costs are what it costs the manufacturers to make their stuff. And they're pointing to about 10% increase in costs. And they're saying the next tranche should push us up to 15% input costs increase. So that's flat out inflation. But the output cost, this is saying how much are they passing on to the next person in line? That can be a wholesaler. It could be a manufacturing selling to a wholesaler selling to a retailer selling to the consumer. The output costs are how much is it getting passed on to the next person in line. And it's only, in this about 5% level. How long can a producer eat that cost?
I guess it depends on the margins, right? But they're
Right?
gonna try. But again, they're gonna try to.
They're going to try to keep their cells going, right? Their total
Right.
production. They'll try to eat some of that. We have what's called elasticity of demand, and whether there's good substitutions. We have whether or
Mhm.
not they have any margins to be able to do so. And in the end, these get into lockstep. And there's times like what we saw in the grocery world, inflation went up 10%. What did groceries do? Groceries went up 20,
Mhm.
in some areas, 25 and 30 and even 50%. And so sometimes your output cost will outpace your input cost. And so as we see this is going to catch up, or the margins in the factories and industrials are going to disappear. So even if they eat the cost, what happens with earnings?
Right. That's where earnings are gonna get crimped, right?
So either you're going to destroy earnings
Right.
because they're eating the margins, or they're giving up their margins to eat the increased cost, or they're going to pass on to consumers, which causes the consumers to buy less, which drives earnings down.
Right.
And the
And,
lower the earnings go, what did they do? They say, we're going to have to make some cuts. Either we cut
yeah.
equipment or we cut employees. And if they cut employees because they have no margins, what happens? Well, consumers don't buy as much.
Yeah.
And what happens? Their earnings go down.
And assuming
So,
they're employing those people in the United States, it may or may not affect
right.
us as much. But look, I mean, from my perspective, again, the tariffs, we know that it's going to be bearish or impact stocks profits at a minimum, right?
Right.
And again, if we're saying if now we're saying, well, tariffs and we're lowering the dollar, I'm like that this is going to create greater earnings pressure from my standpoint. Again, this is a bullish day for the market, but we're not really talking about a bullish result.
Right. We're not talking about long-term health in the companies and margins and earnings and profitability. We're talking about cheaper borrowing costs,
Yeah.
lower dollar, and that's going to mean more money flow. But at some point, money flow without growth is the very definition
Yeah.
of stagflation.
And that's where, and again, right now, that stagflation result is typically good for gold.
Mm-hmm.
It can be okay for other commodities as well, metals, especially oil can sometimes, especially right now, where that may help kind of create some drift there. But yeah, that really pushes you to late stage in terms of that cycle. So,
Yep.
well, I'll let you
All right.
get on with JPOW.
JPOW. JPOW and the US dollar. All right. Thanks, Brandon. Have a good
Have a good
weekend.
one. See you, folks.
All right. All right. Yeah. And so in the end, are we going to bail out the big companies? And Alex says they'll cry to the White House for subsidies and tax breaks. The fact is, what if they do? what percentage of US companies and employers are small businesses that don't really qualify for those bailouts? At what point does it not get to 38% of the businesses that don't really play into that? Now, rotation is still in play. I want to talk about a couple things here. We're going to look at some long-term trends. I do want to talk about that data that I just was alluding to, but specifically in comparing industrials and basic materials for the trade opportunity. I talked about it yesterday, not knowing what was going to happen today, but this is still feeding into the same concept. We do not need to assume that we're not able to still participate in that move in the basic materials and not necessarily chase industrials, despite what we saw in PMI. Whoops, wrong way. There we go. And so if we saw industrials doing better, well, PMI says we are. And we'd say, well, that should appear in transports. It should appear in PMI services. And so these should be here. But what we saw is that would be early expansion. Are we going to jump from here, where we were talking about last week, to suddenly back over here again? And basic materials can move up when we see the idea that bond prices are falling, that interest rates are going up, that we see growth and expansion in there, or it can be moving up because basic materials have bigger margins. And so what I've talked about over the last couple of weeks is we've talked about the idea of metals and mining and oil companies and others. If they are just holding, if oil's holding at the high, if gold's holding at the high, we don't need those to go higher to see the companies keep their revenues, their earnings, their margins. Their margins are already high. They just have to have it not go down against them. But the people that are buying those basic materials are the ones that we need to pay attention to, because they are the ones exposed. They're the ones that have that input cost, the cost that they're paying as it comes into their factory, into their manufacturing facilities, into their service organizations. They're the ones that have the higher costs, and they have to decide, am I going to pass it on? Am I not going to pass it on? If I don't pass it on, my earnings fail. If I do pass it on, my sales fail. And so there's the quick over 10,000 foot view of what the problem is. So as we're watching this, I want you to look at a couple things. We want to look at 6-month rotation and 3-month rotation. And you're going to see some of the same ones are at the top in the 3-month versus 6-month, and some are not. They're very different. The idea that I like with the 6-month versus 3-month rotation here is the 3-month is those that are adapting in the shorter time frame, quickest in the setting up of the next rotation. The 6-month is kind of showing you backwards to that idea of GDP. GDP is 2 quarters, positive, negative is recession, positive is growth. So if we have 2 quarters in a row with positive growth, we say, hey, we're doing well, we're climbing, we're growing. If we have 2 negative in a row, that tells us that we're in a recession. But as Brandon already stated, by the time we hear it, it's too late. So we want to look for these changes in the 6-month and in the 3-month to see which sectors are climbing, which ones are failing. To do that, we're just going to make a quick list. And I've got my SPX chart compared to the sectors right here. On the 6-month, let's look at the top 2, bottom 2 on the 6-month, and then we're going to look at changes in the 3-month. So the very top 2, bottom 2 here, we look at here, this is going to be technology, and this is consumer discretionary. Oh, nope, it's industrial, sorry. Consumer discretionary is down here. Industrial. So I've got XLK and I. Those are your top 2. The very bottom down here is healthcare and energy. Okay, so we're going to put this last quarter. Oh, I'm just doing the last letter of XLK, XLI, XLE, XLV to give us that quick view. Okay, so the very top 2 versus the very bottom 2 are in place for 6 months. Now remember, this 6-month view is delayed, it's lagging, it's a problem. It's always late to the game. So if we look at the top 2, we say, yep, they're the best. But if you look at this, really, for the last 6 weeks, have we gained? And we look at the weakest 2, for the last 6 weeks, we have dropped, but we've recovered. In fact, we recovered from 13% to 6%. We recovered from 6% to 3%. So they've offset half of their losses in the same time period. So this is going to give us a very different story. If I go into, oops, undo. Hang on, I got to put my lines back up there. Erase, 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 erase. And let's change this to a 3-month. To change it to a 3-month, who are our top 2 and bottom 2? Now, the first thing we need to notice is the top 1 is still technology in the 3-month, but the second is the broad market. So what do we need to be aware of? And I brought this up once before, just anyone that knows the answer. What do we need to be aware of if the second strongest is the broad market, which means the broad market has outpaced 10 sectors? How does the sum beat out 90% of the sectors? What is it that we need to be aware of in these situations as we see this move? And by the way, let's get the bottom 2 while you're typing in what you think. Consumer staples and real estate. So in the shorter time period, we have consumer staples and real estate are the bottom 2. Energy and healthcare aren't there. Energy and healthcare are recovered. They're pushing higher. They're in the positive. They've grown 6% in 3 months instead of negative. The very top 2, technology and the broad market. Oh, but healthcare. So if we ignore the broad market, we have technology again and healthcare. So we see a massive reversal in healthcare and energy in the last 3 months. Consumer staples and real estate are down here at the bottom. What does that tell us? The fact that the equity market itself is outpacing 90% of the sectors. That tells us we're just too heavily weighted into this. So the question I have for you is, if weaker dollars going to sustain technology enough to keep the broad markets afloat? Or is that overweighting in technology that's causing the S&P 500 to be the second strongest compared to included in the mix of all sectors? Or are we setting up for the fall? Does this feel like the .com? When none of the other sectors can keep up with the technology and the broad market, because the broad market is so heavily weighted. The money and the capital flow is so high into technology that we have offset everything and pushed that to the next level. Does that make sense? Just that few. It's the Mag 7 like we've talked about before. It's just the few stocks that are lifting it too fast, too far. The capitalization in such a small number of companies, 7 stocks account for 35% of the sectors. So we want to watch this technology sector for when it does break. And I notice I said when. It will. There will be a shift and capital will flow out. The question is, how long can the dollar's weakness, sustain that? Cheap money sustain that, and capital flow sustain that move. When that breaks, when that reverses, what you're going to see is this reverse. So now this is the euro versus the US dollar. And I want you to understand what this chart is telling us from the dollar weakness and what we're seeing here. As we're looking at this, we'll go back to the technology. We'll look at all the others as well. Now, Tim, being at an all-time high does not mean the capital flow has moved there. The amount of capital flow that's moved in that area is nothing compared to what we've seen in the technology. And I'll show you how to read that in just a second. But the lines in the background, I've got some channels that I'm trading, and I've been trading channels since the report or the statement. But as we're looking at this, these blue lines is a single day deviation or a single day distribution level. And we went from what we call fair price to 100% to fair price. So in just 5 minutes, we did a day and a half of range. So what would be normally 1 day, we did in 5 minutes. We then followed it through and did 2 days distribution in under an hour. 2 full distribution days. Now that is a lot of weakness in the dollar and a lot of strength in the euro. You'll see the opposite on the dollar index. And I'll show you the dollar index. Then we'll get into financials to show you how this money is moving. Let's go into the dollar index here. And the dollar index, kaboom, all the way down. And it went from trying to get bullish to trying to get bearish. It still hasn't broken out of the month-to-month levels. This sell-off, this reversal, is still playing to the long-term distributions, right here to right here. But that drop as a percentage, and this is a good rule of thumb you can use anytime. If you want to talk about dollars purchasing power, the dollars purchasing power went from peak to trough approximately 1.25%. So if the dollar loses 1.25%, equities should increase by 2.5, equity indexes should go up 2.5%, and individual equity should go up 5% of, or 5 times multiple, sorry, 5 times. I didn't mean 5%, 5 times multiple. So what we should have seen today, if it's just mathematical about the dollar's purchasing power, we should have seen equity indexes go up 3.125% off of their lows. We should have seen the individual equities go about 6.25. Now, if we go back here and look at the NASDAQ, we're looking for 3.125 off of the lows. Well, here's your low, here's your high. We went 2.5. What seemed like a massive, massive move is not being reflected in that dollar's move. Theoretically, there is more upside. Or the dollar got knocked down too far for what was stated. Those are your choices. Either the dollar was overly aggressive, pushed lower, and it's going to bounce, or equities still have more upside. And based off what we're seeing here, I don't know. We're pulling back right to a monkey bar level. We're holding up at that 0%. So we're going to wait and see. But even then, if we go higher and higher, if we move to the next level, the concern is, where are we going next? What is this really telling us? Do you think we can clear those highs when we're overly inflated into those tech stocks? And at what point does the dollar hold its value? Or what is our next barrier? And I'm looking up here, and we could certainly go through, get rid of a few of these lines. And I want to show you that capital flow. Okay, it's all tied back into where's the money moving. Money does not disappear. It moves. It shifts. It changes hands. It goes from one pocket to the other. It goes from one country to the other. It goes from one sector to the other. It goes from one instrument like bonds into equities, equities into commodities. So as we're looking at these moves, we're going to get back to basic materials. As we look at these moves and this huge move, it's a lower low, higher high. So we cleared out traders on both sides. We returned to touch the month-to-month fair price and failed. That's it. We found fair price. So even if we go up higher, I'm looking at that 23,641. I would expect it to be less aggressive if we really thought the money was moving into the tech companies, which are the strongest ones. And you can see, no, we reversed all of it and returned to retest the previous highs. To me, this is a sign that we are starting to push away from tech as far as the flow of capital. Now, I will show you, like I said, how to look at capital flow. I think the easy one to do is go to Market Watch, change visualization into Index Watch, change your watch list. And let's start with S&P 500, well, S&P 100. And as we look at this, the amount of money that moved into the up issues versus the down issues. 86 issues versus 16. Well, we've got about a 7-to-1. We've got about an 11-to-1 in volume, but this is the big one. We've got about 13 times multiple of money. I don't care if the volume's higher or lower. I don't care if the issues are higher or lower. I want to know how much money moved. And what we have is $2.75 billion in capital have flown into advancing issues versus declining issues. So we have 13 times the amount of money going into up stocks than down stocks. 13 times 2.76 billion versus 203 million. As we go over here, we can change this. Our top sector that is financials, we can go into individuals, but our top sector that is financials would be the Russell. And if we go to the Russell, say the Russell 1000, we'll start there. We look at the volume here. The volume going into advancing issues, 5.5 billion versus 431 million. So as we're seeing the money flow there, there's your financials today. $5.5 billion in capital flowing into those. And then we can look at the individual stocks and try to pick those out. If we look into, to get a financials index, let's go with, there we go. Well, that's not going to help me. I would like to be able to see this, but just so we can see, this will give you a quick view of the sectors. Top sector, Dow Jones. This is my own list here. There's your basic materials. Over here, your consumer discretionary. Where's my financials? Right there. So the financials are about 1.25% up. Capital flow. Well, the volume's 23 million. It's not going to show me the capital flow into there. I don't know why it's not showing the dollar index, because there's no volume there. That's why. So everything compared to the dollar is up. But 1.25%, 23 million in volume going into the financial sector. So this is something I take the time to look at over time, not just in the individual days, but over time I look for that to show me where the money really is moving. So again, the dollar was probably oversold. Sectors are probably going to struggle. Betting against the uptrend? No, the uptrend's real, but it's a matter of timing. So if we look at this and go into the shorter time frame, and then we'll get into, like I said, basic materials, we look at this and we say, oh, we're fading here. If they were really trying to mirror the dollar at 2.5 times, we came up short. The fact that we're continuing to sell should tell you that the dollar has probably been oversold. And so the dollar's oversold behavior should be basing out, creating, I don't know, a higher low. And if we get through this higher high, I'd expect the dollar to come back up and recover off of its lows to where I might see it go back up to, say, another 0.36. That would bring us to about 1.1% in the dollar's loss for the day off the high. And that should bring us back in line with what the sectors did and the individual indexes did. So the dollar's purchasing power got knocked way down. If we compare it to historical values, we dropped back down to key support. Is this the reasonable level based off of rate cuts? Well, wasn't this reasonable? Wasn't this reasonable? These were all levels that we'd look and say, what did we see with the Fed? Well, the Fed meetings were right through here, and then we went higher. Dollar got stronger because we did not expect rate cuts. We came back down through here and they started going higher and said, oh, maybe we will have the rate cuts, and we dropped right back to that support. If this backs away at all, not only do we expect to go back up, but I would minimally expect it to go up that 0.3 to about 98. So it does feel overshot. Take a look at bonds. Here's bonds. Is money moving into bonds? If we really were expecting a rate cut, bond prices should go up, rates should go down. And I covered this Tuesday, with the idea that we demand the existing bonds until we find equilibrium in the markets. I guess it was Wednesday that I talked about that. So sure enough, all the way back up again. Did we clear the high? No, I'm not convinced we are going to. We bounced back up and we're still below these levels. It's going to take more than just a comment about that he's concerned about the labor market to get us through that level. So I'm not convinced that this is ongoing. Bonds up and equities up same day, that's not sustainable generally. So we're going to watch to see what this is going to do, but bonds up and equities up same day Watch for this to drift back to about 111.29. Now back to the discussion of industrials versus basic materials. Industrials did not get much of a rally yesterday off of the sentiment that we were going to see, or that we saw PMI show us that we had growth back above the positive 50 level. This cheaper money is a good thing for industrials, but what it will do theoretically is it should hold up basic materials even more. So yesterday in the video, I talked about bet on basic material stocks, but don't bet on industrials yet. And we had a gap up close up yesterday, and then we gapped up and continued higher today. And it's a bigger return on basic materials than it is on the industrials. So if we're going into this, the stocks I talked about yesterday, and I'm sticking to this, the stocks I'd be looking for are the stocks inside of the basic materials, which would include packaging, containers, because if they're going to make stuff, even if they don't have margins, factories still are going to buy packaging and containers. We're still going to buy the raw goods and metals from metals and mining like Newmont and Freeport. We're still going to be buying into agricultural, which is we're looking at for things like in CF and Mosaic, but Mosaic was too high. I wanted it to pull back, and it did pull back for us today. If we look at the individual stocks here, we're going to walk through and pick a trade out of this. So IP, I talked about buying yesterday. Well, on the open today, that would have been a fantastic buy at 48. My question is, can we still buy in? Let's walk through the analysis. If IP is a good buy, yesterday it was offering us a pretty decent return on selling the at-the-money put. And I talked about that again in the afternoon video. Yesterday, it was telling us that we could have got about 3% for selling at the money when we were down here at 48. So at 48 is going to offer us 3%. Well, today we're up at 49.40, and it's still offering us that same 3%. The question is, do we buy here or do we sell here? Do we sell premium and collect 3% for the next 28 days? Or, scrolling down to the bottom, where current IV percentile is 13%, do we buy the call? Do we buy the stock? What are your thoughts? What do you think? At 13, even though that 3% is pretty tempting, the fact that we already moved, I'm interested in getting up to 51, potentially up to 53, and even up to the highs of 56. Let's target 53.60. If we're at 49.40 and my options are inexpensive, if we're at 49.40 and the options are inexpensive, I want to be a buyer. It'd be nice to be able to buy closer to 49, but we'll just deal with what we have. If I think it's going to go to 54, excuse me, sorry, couldn't get to my mute fast enough. If we thought we're going to go to 54, I'm talking about a 10% increase from where we're at. And that would be also on the 2.8% increase that we already had. If I'd have sold the put, it's a pretty safe trade. If I'm going to be in this position here, and I think we're going to go for 54, 53.60, let's go ahead and take a look at the option and see what would happen with that option. 13%, I want to buy more than 28 days generally. I want to buy more than the 3 weeks at least. I want to buy 4 weeks and more. So we might have to go out to September 26th. Looking at our implied volatility out to October would be very inexpensive because we're pricing in some earnings there. But if we went all the way out to October, it's going to be very cheap to buy a call spread or calls flat out. If I were to buy at the delta near 70, I'd be buying the 47. Spreads are too wide. Let's go back. Let's deal with this since our spreads are going to be narrower. We're going to buy a delta near 70, 47.50. And if we think we're going to go up to, as we already pointed out, we're going to go back up to 53, 54. That's going to give us a delta way out here at 26. I'd be buying in at 47.50. My extrinsic value is 85 cents. I want to sell at least that much premium, 85 cents, and that means I'd go for the 51. So even if I think it's going to go up to 56, or 54, this gives me a spread of 47.50 to 51. That's 350, and it would cost $1.95. There's no time decay in this now. I'm not paying for anything. I'm just paying for equity, 100% equity. If I analyze the trade on IP for this level, go into the risk profile, set slices to break even, this is going to give me a probability about 50-50 from where we're at, and we're risking $1.95 to make $100. I'm sorry, $1.55. $1.95 to make $1.55. So the fact that my reward and risk is skewed here and the cost is now flipped, it was better earlier. I had about a 1% edge. I have no edge here now. There's no edge left in this. So I can't really chase it. I don't really want to trade it. And so we got to leave it alone. But the trade might still be good just to buy the call. So this covering that and limiting my return is not going to work there. If I bought the 70 delta, let's change this to Theo price. And if I buy this at 47.50, the 70 delta, and we get up to my target being up here at 53.60, I can look at this from that view. We're going to go from where we're at, we're going to go up $4.10. Well, I said 53.60. We'll put it exactly 53.60. So if I'm going for 53.60 and I bought the 47.50, my $2.85 should be worth $6.13 if it happens by September 5th. That gives us 3 weeks of the 4 to get there, and I make a return that is a multiple that is almost 250% return. So the options are inexpensive enough that that would be worth my while to trade up to that target. 2.5 times results profit if it can get to my target in 3 out of the 4 weeks. So I'm using up most of the time. And if I get there, that means a lot of the time decay is kicked in and I am still safe, and I'm looking for that solid return of about $325 on a $285 investment. Same thing is going to happen on some of these other positions that we're looking at inside the basic materials. So let me just go back and show you the ones I like. And I talked about this again yesterday: SW, IP, PKG, FCX, NEM, NUE I did not talk about yesterday, but I do like that one. Mosaic, I wanted it to pull back. CF is flat on the day, and I still like CF for the opportunity. So I would go through step by step each one of these and try to determine what the reward is, what the probability is on each trade. And these are longer term trades. They could go into the very long-term setups. Do market makers really care about overlay inflated XLK type stocks? Well, they care because they make money either way. They're going to make a lot of trades in there. Yeah, market watch tab, heat map, index watch. Market watch tab, index watch instead of heat map. Yeah, and today's an interesting day. To Carter said it's a good day to sell premium. As we're looking at these, even on up days, this is when you can see volatility rise because the market makers are having a hard time making the market. That's their inability to price in risk. So even when the market spikes like this, you can get higher volatility on days like today. So even though the market climbs up, the risk and uncertainty back to the market makers is being priced in. When would I close IP for a loss? I like IP unless it gets through 46, but now that it's already moved up to this level, I would say just trades below today's low. Close below the close. So there are times that, generally speaking, when volatility is, well, let me just say, when the markets are selling off and people are hedging, volatility is going higher because people are hedging and they're paying for insurance. But when you got to remember, the market makers are also setting the prices. The spreads are going to get wider, which we have already seen today. the bid and ask price between options is going to get wider. Hedges are going to get wider. Buying gets more expensive. And so volatility increases across the board. So it is possible to have higher volatility on up days. Generally, it is on down days, but it is possible. It is completely possible to have a higher volatility on these up days. And today, whereas an outlier, a surprise, a super move, then that would be the case. We'd say, okay, well, this is also a time that we'd be looking at it for higher volatility, even though the markets are climbing. Now, if we look at PKG, I talked about it yesterday, breaking through the 52-week, or this high, not the 52-week high, breaking through this high. We're near the 6-month high now. And the idea is that it was going to go from here to here, and it's already gone halfway to my target. So I don't know if I'd chase this one down where it's a breakout, but I do think we could go up to 230. Question is it worth the remaining $15? If you want the implied volatility of individual instruments, you can put individual instruments and even individual stocks here. Put in the indicator, go to studies, edit studies, type in IV or implied volatility, IMP, sorry. That's what will get you. Implied volatility, IMP, imp volatility. Add that in there, and this will be the implied volatility for the sub instrument. So as you're looking at this, you're looking at the individual stock. Now, it is down today on the SPY. It is possible, like I said, the options are increasing because the spreads are wider. So this drop through here, as equities climbed up and are holding near the highs, it dropped here. But individual stocks and sectors, let's take a look at, well, you had Tesla up earlier. So Tesla, who is up, it's down a tiny bit. But the fact that we erased all this, theoretically, we should have volatility at its lowest level. If that's purely about directional move, 1, 2, 3, 4, 5. It's the highest close that we've had and almost the highest price that we've had since here. So it should be, volatility theoretically should be at its lowest level in that same time frame. But it only faded a little bit with that big move in equities and the price up through here. So that'll give you an implied volatility. You can also compare to historic volatility, but this is just a daily implied volatility. And my understanding, and Don could probably confirm this, it should be in, at, and out of the money options volatility through there. Here's some other examples of rising volatility. Hard to see changes, but I'm looking at the numbers go from 16 to 18 to 20 when prices were going up. So you can have rising volatility and rising prices. Yep, there are historic volatility in there too. Yep, for sure. All right, I've only got a few minutes, so let me I've only got a few minutes left. So let me do really quick some reviews on some of the other things I'm looking for. Newmont broke the high today, 52-week high, broke out of the monkey bars, climbing. I like Newmont for the next move, which could go all the way up to 76 in the next 2 weeks. Newmont Mining, and remember, they don't have to have gold go up to make money, but when gold does go up, it means they're going to make more money. So they're holding Newmont, Freeport, all these gold companies, all these gold miners, they're holding near record high margins, and it doesn't need to go up anymore for them to still collect those record high margins. Demand's going to really drive how much they do, but they're still at record high margins up here. If it goes higher, then the record high margins could get higher again. So I'm looking at Newmont and Freeport and any of these, including basic materials, if we're going to have demand for products, even if the producers are absorbing the margin, they're still paying the basic material costs. So Freeport and Newmont and Nucor all are at these high levels of margins, and if gold and silver and copper and platinum and palladium and nickel and all going back up, then the companies that mine those are going to continue to move higher. And we can look at individual stocks, or we can just say, you know what, I'm going to buy into that ETF. I'm going to distribute my risk across multiple miners. And Sure enough, we've created higher highs, higher lows. We've bounced. If we close above 80.8 or 80.73, I'm looking for 85 on XME. So the basic materials are very much set up to give us continuation. You see how green everything is on the chart today, but these were all green yesterday when we were flattened down. We're seeing Smurfit. I don't know if you're supposed to say Smurfit or Smurf it, whatever you say, but Smurfit. Oops, SW, sorry. I'm going to type W. Options are relatively cheap. And you could be buying the in the money delta near 40. And if we're going to see this move, and this one is a more inexpensive one, this is the breakout. If we can get through here and get back up to the previous highs, we're talking about 49, and it could happen, as you can see today, in 2 days, theoretically. But if we give ourselves all the way out 3 weeks, and we look at the same kind of move that we're looking for before, which is 45 to 49, that's a $5 move. If we get a $5 move and get up to $50, our $40 strike costs $6.10, could be worth $10.58. You could do a spread there too, but directionally, it might be worth just buying the stock because they do pay a 3.78% dividend. My whole point with all of this, yesterday's video and today, regardless of what the Fed said, regardless of what the Fed did, we didn't know he was going to say that. We didn't know he was going to be concerned about jobs or labor. But what we saw yesterday, paying attention to the PMI, paying attention to the difference between basic materials and industrials, paying attention to the fact the input costs are going up dramatically, but not output costs, which means the manufacturers and the value add type of facilities are eating the costs and not passing it on completely. That does not change the fact that all these companies are making money. Does that make sense? Pay attention to those because they're going to continue to move. And there's opportunity in each one of those. But Corey is in the house and he's going to take over. So let me hit stop record here.